Hey, this is Matt O'Neill with Matt O'Neill Real Estate, here to make some sense out of what the new tax bill means for the housing market. So I'm going to have to read a little bit from the paper because there were a lot of changes and there were some things that were talked about and that didn't get implemented. And so I'm just here to present to you the facts today of what the new tax bill really means and its impact on the real estate market, especially as it pertains to us here in Charleston. So first is deductions for property taxes. Prior to the new tax bill, if you itemized your deductions, you could deduct all of your property tax. But going forward, this amount will be capped at $10,000 per year. So what that meant was if you had property taxes of $20,000 or $30,000, you used to be able to deduct that entire amount from your taxes, and now you're only allowed to deduct $10,000. This will make homeownership more costly, and that is a force that would maybe have a negative pressure on home prices. Deductions for mortgage interest. The final bill reduces the limit of deductible mortgage debt to $750,000 for new loans taken out after December 14 of last year. Again, what this means is that it's going to be more expensive for people who are purchasing homes over $750,000 because they won't be able to deduct that mortgage debt beyond that limit. For the high-end purchasers and high-end home owners, that will make home ownership, again, more costly, which could have a negative effect on those prices. Home sale exclusion for capital gains. If you sell your home and turn a profit, up to $500,000 of that profit is tax exempt from capital gains. Earlier versions of the bill required you to live in the home 5 out of the last 8 years. They repealed that piece of it. They just made a cap of $500,000 on your profit for a married couple, two people who can combine to get a $500,000 capital gain exemption. And you have to live in South Carolina, you have to live in the house 2 out of the last 5 years in order to get this exclusion for capital gains. The last revision is deduction for moving expenses. The final bill repealed the moving expense deduction except for those who are members of the armed forces. These are the most tax relevant changes for real estate. So there's just 4 main changes. 3 of these 4 really are going to have a negative effect on home prices because it'll make owning a home more costly. We get fewer deductions. But right now in the market that we're in, it's not going to affect us going into 2018. Really, these changes are going to have effect on us in the long run. And especially as we see the market change from what is a seller's market. The markets always go from seller to buyer and then back to seller and back to buyer. We're in a strong seller's market. At some point, this is going to shift. There's going to be more inventory than there are buyers. We don't know what year that'll be. It's probably going to be after 2020. But at that time, these changes will have a more dramatic effect on home prices because it will be more costly to own a home. Overall, the tax bill, I think, we're going to be in good shape for this year and next year and probably the year after. And then we'll just see how things progress after 2020. If you have questions about taxes or real estate or thinking of selling or buying a home, reach out to us, mattoneillrealestate.com, or call us at 843-619-0401. Appreciate you listening.